additional headache that has affected every section of the society, especially the mandarins on Main Street who determine India's monetary policy. The retail inflation in May surged to 6.3%, with food inflation rising to 5.01%, while the wholesale price index based on inflation spiked to a high of 12.94%, much above the Reserve Bank of India's threshold level of 4 plus minus 2%. Inflation in layman's terms means an increase in price of goods, including food and other necessary items. Simply put, it means more money chasing the same amount of goods or the same amount of money able to buy lesser number of similar goods. So when inflation rises, purchasing power of households goes down, leaving them with less money to spend on other things. In essence, a rise in inflation witnesses a parallel phenomenon of a degrowth of non-essential items. The inflationary numbers couldn't have come at a worse time, as the RBI's household survey showed a sharp decline in consumer sentiment, with consumer confidence index hitting an all-time low. Inevitably, an increase in spending due to higher inflation has a negative impact on household savings, which in turn eats into investments with less money on hand to buy stocks or invest in saving schemes, creating an uncertain future. A higher inflation for a sustained period of time leads to an increase in interest rates, thereby raising the cost of capital. A company has to pay more for its bonds to raise capital, with future cash flows of the company being taken at a lower value. As valuation of equities are done by discounting the future cash flows, hence the equity valuations see a downward revision. So often, to control inflation, the central bank raises the interest rates, bartering off growth. For companies, the inflationary pressures would see a rise in input costs, resulting in an adverse effect on its bottom line growth. It creates an overall negative sentiment. Conversely, on the other hand, a low inflationary pressure leads to lowering of interest rates, ease in cost of borrowing, lower input cost, and cost of raising capital. All these factors result in investors flocking to that country or parking their money in stocks to get a stable return. FPIs, who've played a determining role in the Indian stock market since decades, generally tend to borrow in countries where the interest rates are low and invest in countries like India, where the rates are comparatively higher, with spread being the profit, which is, however, contingent upon currency fluctuation. But if the inflation is too high, RBI historically raises the interest rates, thereby disincentivizing growth. It impacts the stock markets adversely. In such scenarios, FPIs generally pull out. Hence, a substantial rise in inflation negatively impacts the stock market. But there are exceptions. When a government pump primes the economy by providing a stimulus, cuts down on tax rates, or reduces interest rates to boost growth, we often see a rise in benchmark indices. This is true when the inflation is moderately high or just above the threshold limit set by the central bank, and growth is given the priority over inflation in immediate to medium term. But then one would ask, if that's the case, how come benchmark indices rose during May without any tax cuts or stimulus? It's true that none of these factors played any role during the month of May when the benchmark indices went up. Both Nifty and the Sensex climbed up during May despite the inflationary pressure on the back of a positive sentiment. The decrease in COVID-19 cases, prospect of availability of more vaccines, imminent opening up of economy were the game changers. The control over the pandemic had a spillover effect on FPIs. They did infuse $746 million into the banks, $153 million in metals, $129 million in capital goods, $124 million in utilities, $100 million in automobiles, and $94 million in consumer goods. Further, the sequential profit growth of Indian companies bettered the street expectations. The overall assets under custody of FPIs as of end May 2021 stood at $596 billion, $49 billion higher than the $547 billion AUC level at the end of April 21. Overall, a negative inflation or deflation is also not good for the economy, particularly the producers. A price decrease disincentivizes an increase in production of goods and services, resulting in a dip in not only of profit but GDP as well. An optimum inflationary level has to be maintained to spur economic growth. For the RBI, though, it has to be a balancing act for now, as it has to meet a two-pronged challenge of lowering the inflation without compromising on economic recovery.